Episode 522, Trading Justice Podcast. Justice Boys bringing it to you on a Sunday afternoon. This is our new schedule. We're going to continue our part two of our conversation on the history of the dollar. Matt, normally I would say some more intro here. I mean, there's freaking headlines constantly every week now on the dollar and this and that. And, you know, the conversation is certainly a timely podcast topic. To have a little series, isn't it?
It certainly is. I mean, just in the last couple of weeks, China signed an agreement with Malaysia to use non-US dollar transactions in political just today.
And Malaysia Prime Minister said, hey, we don't need the dollar. Like,
it's a lot more. When I was first doing the research on this, well over 10 years ago now, I kind of felt like I was the one wearing the tinfoil hat talking about the dollar and us losing reserve status and what China was doing. And now it's just in mainstream media.
Oh, bro, it's mainstream
everywhere now. And it's like, honestly, I kind of sit back. I'm like, well, welcome to the conversation we've been having for well over 10 years now. And, you know, and honestly, you know, it's kind of frustrating sometimes because these are major, very, very serious conversations that have an impact on everybody in countless areas.
Your future, your children's future, your grandchildren's future, right?
We're debating what is woke and what is not woke in America. China and other countries around the world are taking action, and we need to get our act together on that front. But again, that's another conversation for another day. The simple reality is these things have been happening. They are currently happening. And the future of the currency is, I don't want to say at risk. It's the future of the currency is changing. It's constantly evolving. And unless you're at the forefront of those constantly ever-changing, you know, the ever-changing evolution of the dollar and currency in general, it's tough to be the backholder on a currency on a currency evolution. It's really tough.
Yeah, no, listen, and so we're going to pick where we left off last week here in a few minutes with the gold standard, right? You know, just when things changed a little bit and fiat currency, it's all freaking worthless. Like you know, it feels like I'm going to go out just 15. It feels like we're in the Matrix. We have to recognize that it's real, right? Mm-hmm. But it's not really real. But you know, we could dive into that rabbit hole. But Matt, before we get going into that, picking up a part two, let's go through our market skyline.
Yeah.
This past week was one clear theme. It was winter is coming, right? Recession is on its way. You know, and you saw it in the pricing. We saw defensives outperform cyclicals by the widest margin since like last October. So big, huge gap. Defensives run up. Bonds had a good week. Gold had a good week. Broke out of that 2,000 level on the futures contracts. Things that don't benefit from a recession, cyclicals struggled. It was typical recessionary pricing, you know, and people have been debating the recession, Matt, for what, 12, 14 months, like
at least a year and a half now.
Like it's been a while, right? But things ever since the banking crisis, it feels like it's went from this like academic debate, a one-day debate to, oh, this could be happening debate, right? Like type of thing where you have more people in the, you know, there was a poll recently out from Bank of America that 53% of investors feel like a recession's coming this year, right? So, I mean, it's certainly picking up the chatter. And, you know, and it all is on this basic Econ 101 thing. And I just want to throw a couple stats and have you talk about the recession for a few minutes. So, I mean, we saw in data that came out this last week that we had the biggest 2-week drop in U.S. commercial loans and leases on record. Basically, the sharpest tightening of credit conditions in history. And this is kind of the credit crunch people talk about when you hear this term credit crunch, right? Credit crunch. There's going to be a credit crunch. Well, you don't have to go to Investopedia to see what the term is. This is credit crunch is when banks basically say, we're going to be stingier on loaning out money, and we're starting to see that in the data, and it makes sense from just a common sense, right? Banks under pressure, let's tighten up the ship, and then how this plays out Econ 101 style is, right? Banks lend out less. There's less money in the system, less loans out there, less consumption. GDP contracts. We enter a recession, earnings contract, right? Just basic model. A lot more people seem to be buying into it. Where do you stand? What do you make out of all the data in the situation right now?
Well, I think number one, we need to constantly remind ourselves what we're debating here. The will we not have a recession debate that's been ongoing for well over a year and most likely 18 months or so. Yes, I do think most people in the past 3 weeks, ever since SVB and the banking crisis kind of hit the channel a little bit, that you had to update your GDP projections, you had to downgrade the economy of the United States, and it was based on the credit crunch.
Oh, I haven't been hearing anybody talk no landing the last few weeks.
No, but again, it's also not subprime meltdown. Okay, and so I do think it's important to remind people of what we're actually debating. We're debating the differences between a recession, a slight recession, a little bit of a hard landing. I still don't see scenarios, because when people hear recession, they constantly just get reminded of the last time we went through something like this. And the last time we went through something like this was the subprime meltdown, when 57% of the S&P went down 57%. 401ks around America were literally more than cut in half. And it basically took about a decade from the top to the next top to basically recover all of that. And so when people think back, they always think about the recession that they went through and what it meant. That's not what we're debating. And quite frankly, a lot of the recessionary chatter has been in the market for a year and a half. And ever since we have had the recessionary chatter in the market hasn't went down. It's actually went up. It's actually got a lot more consistent from the bullish perspective. Price action is less volatile today than it was before. So yeah, as we're talking about a recession, also realize we upgraded the market this week as well to reflect the current short-term trend of the market, which is fairly bullish right now. And so as we're debating this recession, will we or won't we, remember the market has had this debate for a long time. It's not new to the market. It's actually really, really, really old hat to the market to a certain extent. So I just wanted to bring that up. But when you're looking at the current economic landscape, you have to expect a recession. How deep does it go, and how far does it run from a credit perspective? Your guess is as good as
nobody knows that.
But the reality is, the credit crunch is coming. And it's based on twofold: the banks pulling back based on what happened with SVB and Signature Bank and Credit Suisse, and just to name a few of the banks. But you also know it from a consumer perspective. Consumers going to tighten up a little bit, as they're now expecting a recession. A vast majority of people out there are now expecting a recession. They're going to button up the hatches a little bit. They're going to pull back a little bit. The banks are going to pull back, and that pulling back, since our entire U.S. economy runs on credit and debt, that's going to have a fairly sizable impact on the GDP. When the banking crisis first came out, I think it was Goldman Sachs lowered the GDP by about a little bit more than 1%. I think that's always going to be light when these initial things happen, and you initially get the updated projections from the IMF, the central bank, and entities like Goldman Sachs. I always think they're a little bit too light on one part of the evaluation. They're right on the math part of it. They're always right on the math part of it. Where they always get it wrong is not understanding the consumer aspect of it, not understanding the behavioral aspect of it. And that's where the recession can really kind of be a little bit worse than what the current projections are right now. Just a little bit of a slight recession, rolling recession. It's a hard landing in this area of the economy, but this area of the economy is kind of improving. You could see something a little bit worse than that, just simply based on the credit crunch coming at us. But again, there's nothing I see out there as of right this very second that would make me fear something along the subprime meltdown, where the entire financial situation was threatened. So it's always important when you're having the conversation of recession to realize recessions are actually fairly normal. They're not that scary. and they actually happen in the financial world far more than you would think about from a pure economic perspective.
Yeah, no, and you mentioned how the markets have been really resilient, and I've had to bend the knee in recent weeks and join the tactical bullish camp. What I've made very clear, plugging my nose and staying in that stenchy place again this week. Being tactically bullish is money, conservatively, all of that. Because the markets have been resilient, and you're always wondering, how should I play any given market condition, right? And if you are in the recession and maybe it's on the worst side, I mean, there's still like lots of areas I'm interested. I'm not interested in cyclicals, right? Like I think that's pretty standard, but like big cap tech.
Well, let me ask you a question,
Yeah.
though. Like you said, you're not interested in cyclicals, but I'm willing to bet there's certain areas of the cyclical conversation you are. You're probably not interested in finance like most people. You're probably not interested in industrials like most people. But I'm willing to bet you're interested in energy.
Only through naked puts. Like I'm very like.
That's still bullish, though.
Yes, I'm not doing bearish plays on energy. I think the shorts got smacked in the nose. I think they're not coming back anytime soon.
Not anytime soon. Not
after OPEC just said, no, listen, we play this game better than you, so.
Well, but that's my point. Like, it's not one of those situations where it's like, oh my goodness, everything in the market is either good or everything in the market is either bad. This market is clearly a sector rotation market. It's clearly a stock pickers market.
Oh, and I would say it's clearly a bullish market in 2023, right? Like in 2023, Matt, you've only had two sell-offs of significance in 2023. One required horrific inflation information data to come in a very short amount of time in different places of the globe that quickly had things discounting and all, like, oh, we were cutting Fed rate cuts at the end of the year, we can't do that anymore, right? You saw about a 1 week slide until some Fed official said the wrong thing and sent the market up. And the other was like banks imploding for like a 3-day period, right? Well, those were the only two stretches, and they took really huge news events, even send the market down for a few days.
And think about it. Right now in the S&P 500, before the banking crisis hit in kind of early to mid-March, and before that double dip inflationary conversation the entire market was having throughout all of February, Mark, the S&P was kind of clinging right around 4,200. Today, we're clinging right around 4,200, and that's with inflation picking back up in February, and that's with the introduction of the SVB, Credit Suisse, Signature Bank banking crisis. And so, yeah, you're absolutely right, Mark. Outside of a little bit of pockets, this market has wanted to run on the bull side of the equation. It's not one of those markets where it's like, oh, we can see the S&P going up another 10%. But as sectors rotate a little bit, obviously it's going to cap the market to some extent. But Mark, when you're looking at tackle trading, and every single weekend we put together the newsletter and we rank all of the sectors in the newsletter. We rank the 3 aggressive sectors. We rank the 4 defensive sectors. We rank the 4 cyclical areas of the market. And right now the S&P is kind of right there in that positive 40 area of the market, right there on the cusp of a bullish ranking. It's got a really good short-term trend. The intermediate trend is still some degree of neutrality, some degree of sideways, but you're starting to punch up into the upper end of that intermediate channel. And if you break out of that 4,200 level, all of a sudden you got a daily trend that's really, really bullish with good momentum. You also have got a weekly breakout there. And it would be very, very difficult to see the market not run a little bit in the short term on the bull side if you do have a multiple time frame breakout. And as the market is in some degree of short-term bullish uptrend in an intermediate neutrality type environment, you've also had upgrades in communications, which is now tied for our highest ranked sector with technology right there at positive 30.
And tell me in your heart you don't like comms better than tech.
I think everybody likes comms tech right now.
I like there's comms is my favorite sector.
There's names in tech, Mark. There's names that really stand out in tech, like Microsoft, like Apple, the two juggernaut, multiple trillion-dollar companies that are seen as the biggest moat of all the moats in whatever economic conversation we want to have. They've all obviously provided leadership. But then when you look at the rest of technology, Mark, and you scan like we do at Tackle Trading, every single stock in every single space, it really paints a little bit of a different picture that if it's not, if you discount, and you can never do this, but it's really good to understand, if you discount Microsoft out of tech and you discount Apple out of tech, which are very weighted towards those two companies, it doesn't look nearly as good as it does right now. And so obviously the tech move has been extremely, extremely weighted towards the Apple of the world, the Microsofts of the world, the big safety tech type plays. Semiconductors have shown a little bit of weakness lately. Software companies shown a little bit of weakness lately. And so it's really those two big juggernauts. And then NVIDIA, you have to throw NVIDIA in there as well, because NVIDIA has been an absolute juggernaut throughout the entire.
Yeah, listen, every time period needs its meme stock, right?
Well, and NVIDIA has been it for like 15 years. So past that meme type stock. But when you look at comms, it's not just Google and Meta.
Matt, I broke down the comm sector because, every weekend, this is when I do very little analytical work during the course of the week. I'm compiling notes, I'm doing this, and I do all my analytical work. I came out, like, when you break down the comm sector, man, aside from the fact that it was beat up the most, right? So your valuations in your two big ones, Facebook and Google, right, are still really reasonable even after a run. I mean, Google hasn't even ran. Let's just call it what it is. It's off its bottom, but it hasn't ran yet.
It hasn't ran.
No.
Not like Apple and Microsoft.
Not like Apple, no. So Google's, but outside of your two big ones, make up you got a lot of staple type names, Verizon, Comcast, Netflix, right? I mean, yes, if market crashes, everything crashes, right? We all know that. But as far as like these quasi staple type plays, AT&T, right? Beat up stocks like Paramount, WBD. Well, it's a pretty good baskets of stocks if you're heading into a recession, especially since the discount has already happened in 2022, specifically in comms.
Yeah, and I think that's a wonderful point, Mark, because when you're looking at tech, yeah, tech's got a little bit of a quote unquote safety bid lately, but again, we know that's Apple and Microsoft.
We know that that's two stocks,
right?
Maybe something else, but
aggressive. Every stock in there is aggressive. When you're looking at communications, it's kind of a little bit of an index in and of itself. It has those aggressive safety names, like maybe not to the same degree that Apple and Microsoft, but it does have Meta on a good balance sheet. It does have Google on a sizable moat.
Both cash-rich companies. You have cash-rich companies in comms.
Very cash-rich. But in communications, you also get a little bit of what's working right now on the defensive side of the equation with your Verizons of the world and your AT&Ts of the world that have been seen as defensive plays since I was born.
I was born, right?
Especially AT&T, but Verizon the same thing. Comcast a little bit of the same thing. All look pretty good. So you're looking at Google on a breakout. You're looking at Meta on a breakout. You're looking at Netflix on a bull flag with momentum. All three of those leadership, all of those big stocks in comms are providing leadership. But all of a sudden, Verizon V-shape recovers, Comcast V-shape recovers. You start to see Disney start to punch up a little bit as well. And again, I think it's a wonderful point that a lot of these stocks in the communication just absolute bloodbath of 2022. They have some valuations that we've never seen in Google, in some of these stocks. So I think it goes without saying, when you're looking at the aggressive stocks out there and you're looking at or the aggressive sectors out there, I do think comms, which is now matching technology from the highest ranked sector at Tackle Trading, I do like it a little bit more because of the quality of names coming out of it right now.
Yeah, what I like when I'm playing something on the bull side right now
Mm-hmm.
is because I'm still bear in my heart. I still think there's an excellent chance we take a significant leg down, but I'm not going to ignore, what my lying eyes tell me about charts and price axioms is that I want things that if we do have a recession, if we do have whatever, blah, 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 who can get hurt the least?
Real quick on that. If all of Main Street is talking about a recession, hasn't Wall Street been pricing this in for a long time?
No, I don't believe that. I don't think they've priced in shit, to be honest with you. Industrials want to be up at the top of the chart, right? You look at the Dow, nothing's moved in the Dow in 14 months, right? It was just a couple months ago they were talking no landing and soft landing. I only think that the Mike Wilsons of the world believe bad things are coming.
Between soft landing and non-soft landing is 1.5% GDP. Mm-hmm. It's like we make a massive deal over these names, hard landing and soft landing, when the debate really hasn't ever been hard landing. The debate has been either a slight recession or we barely stave off a recession. It's the debate of 1.5% GDP, which can be a weather related in the fourth quarter of next year. And so
quantitatively, because I know how my brother's mind works.
Hard recession is priced in. No,
we would not be at the valuation levels we were if any recession was priced in.
If there was not a recessionary conversation in the last year and a half, we would be at a hhigher valuation right now.
But we're still at really high. If you look at compared to any recession, we're pretty stretched. We're pretty stretched.
18.6 right now.
And so
not stretched. That's less than
it's certainly not compared to any recession, right? And maybe valuations are just higher permanently, right?
If you're comparing 08, yeah, we're high valuation. If you're comparing .com, yeah, we're slightly high valuation. If you're comparing 2010, 2015, 2018, 2019, 2020, we're not. So I mean, it's just, what is your comparison?
Well, you're also asking me a philosophical question. Does the market price in? I don't think the market ever prices anything anymore. I think it is a series of quantitative programs that battle it out on algos on the intraday charts. And then we get trends and trends form and all that. I mean, this is a whole subject for a whole nother podcast. I think the notion of markets pricing things in is dead. I think the machines have taken that over on a day-to-day basis.
I have a opposite view of that. I think it prices it in faster than ever, right? Like that's my view of it. I don't think pricing in is dead. Honestly, I don't. I would have to.
But here's the problem. So if the market's up in 3 weeks and it's up significantly, has it priced in the recession then?
It's priced in positive earnings if that's the case.
No, I know. I don't, but this is a whole philosophical debate. I don't believe the market prices anything in anymore.
I fundamentally disagree with that statement.
Yeah, I don't believe that. But debate for another day, because we have more.
Discount everything you see every single day based on expectations on economic reports versus what actually transpires out there. You got to discount a heck of a lot of information to say pricing doesn't exist any longer. That's just something I fundamentally disagree with.
Yeah, I know. Once again, for me, it goes deep into what I'm seeing on zero data option expiration programs and this and that. And
yeah, but
every day its own ecosystem.
Let's not take algorithms, what algorithms do on an intraday perspective and make that an argument that the market doesn't price things in. Because
I think the market at the end of the day is becoming mechanical and technical, and everything else is just
welcome to the party. That's why I've been a technician for a long time.
So I think that is becoming just the world we're living in. But
that was also the case 15 years ago. Like what you just said is the reason I'm a technician 15 years ago, and it's the reason I'm a technician today. But I believe that things were priced in 15 years ago. And
I do not believe in efficient markets, basically. I don't think they're efficient at all.
Yeah, okay. That's a different debate, though, because they're efficient either.
So anyways, when you get us talking and we debate, in fact, someone was joking the other day, when Matt and I agree on 99% of stuff, we'll take that 1% and we will
we'll work it out.
But we're self-aware enough to not let it string out more than a couple minutes. Listen, Matt, there are certainly areas you can play. That's what we were talking about before we got into our nuanced debate. I think it's
comms in.
We're both on the comms page.
Yeah, it's aggressive. when you're looking at cyclical, I think both you and I can agree.
It's energy if you're making plays.
Industrials is stay away. An energy secondary setup following what Saudi Arabia did last week, that looks pretty enticing, quite frankly. And then materials, don't discount materials here. Obviously, gold's been doing amazing things lately.
Aspects of materials, right? Like certain areas of the material space.
Specifically, the mining areas are getting a lot better.
Yeah, no, I know. And then defensives, right? The classic
staples in healthcare.
Well, and here's the thing, Matt. So whether you believe in markets pricing in something or whether you're a skeptic like me, you don't, money rotates, right?
It does.
Whether it is pricing in something or whether it just rotates, that's a fact. That's undebatable. And we've seen that rotation this last week, right? We've seen staples, we've seen healthcare, we've seen utilities that have gotten zero love in 2023, not participated, sold off a little in healthcare, did nothing in other, but they certainly were getting the bid. And when we've seen, and this is what makes these the areas particularly interesting, whether or not you're on the recession, deep recession, soft line, whatever camp you're on, just on a sector rotation level, when you see that rotation start, it's usually not a 3-day occurrence, right?
No, especially when you see it, like, for example, you take, we've been geeking out over communications. When you look at the last 5 weeks of communication, every single week it's been improving, Mark. Every single week, slight upgrade here, slight upgrade there, slight improving condition there. And then all of a sudden, we look back 3 months ago, and it's the best sector in the last day. It's the best sector in the last week. But all of a sudden, it's the best sector in the last month. It's the number 2 best sector in the last 3 months. It's the 3rd best sector in the last half of a year. So, you see these sector rotations, and then all of a sudden, most of the time they don't just get snuffed out and just gone. They have some lasting power a little bit there. And so
there's lots of plays during the course of that, cash flow and directional.
Mark, if it catches a trend, you have multiple different opportunities.
I mean, you think about like the last 2 great rotations we've seen over the last 6 months. You saw it into tech clearly at the start of the year, right? It led, and you are seeing, what are we, April 9th, Easter Day here recording this. 3 months later, you are still seeing trade setups from that initial burst of rotation.
Really good trade setups too. Like 4th pattern within a trend type trade setups.
And then in October, we saw the great rotation, and it wasn't as much a sector as an type of stock, right? Old economy, right? This is industrials and materials, and it was basically the Dow, right? Yeah. And you saw a nice 6, 7, 8 week trend on that, and then it gave you a lot of cash flow plays for another 3 months, right? And so, like, if you can nail the start of a rotation, great, but you don't have to nail the start of a rotation to be on the lookout for secondary setups. And I think that's where we're both on defensives, right? Being on the lookout for those secondary setups.
Well, and when you're looking at the defensive areas right now, and again, you got comms in aggressive in tech with Apple and Microsoft. You got energy and basic materials to a certain extent within the cyclicals. Staples and healthcare have been pretty good recently, especially staples. Healthcare's playing some catch up to staples very aggressively. Healthcare's looking really good, and you were very early on that healthcare move. And so those are just ongoing conversations to me. But Mark, what really kind of surprised me and came out of nowhere a little bit this week was utilities. Utilities kind of jumped on board a little bit there. And when you're looking at utilities, and again, healthcare in the last months up 5.9%. Healthcare in the last weeks up 3.84%. Healthcare in the last day up 0.6%. What you're seeing is the momentum come into healthcare in the short term. The same thing can be said, and Staples a little bit different because Staples didn't just come out of nowhere this week. It's kind of been the last couple of weeks. But you can say the same thing about healthcare and the same thing about utilities. Utilities in the last week up 3.43%, healthcare up 3.84%. In the last month, utilities up 5.7%, healthcare up 5.99%. Both of those sizable moves in the last month, both came in the last week, Mark. Before that, healthcare and utilities were doing absolutely nothing. And so you're seeing, just in terms of the percent move this week versus the last month, you're seeing momentum come into consumer services, but that's been there for the last month. You're now seeing it in healthcare. You're now seeing it in utilities. And so it's unmistakable out there. You are absolutely seeing rotation.
And Matt, it makes so much sense to me,
Well,
right? Like, you know, like if money's going to rotate, hey, listen, cyclicals might have a day.
Consumers, though, Mark,
Yeah.
because it's not like all of a sudden Jamie Dimon, Wall Street, Larry Fink, and Goldman and BlackRock are all huddling up and debating a recession this week. That's not occurring. They've been debating a recession for the last 18 months. It's not like you and I are sitting down for the first time in 2023 or 2022 and saying, hey, what about that recession? Do you think it's going to get nasty? No, this is our 15th conversation in the last 15 weeks on a recession. It's Ma and Pa America that's waking up to the recessionary conversation. And Mark, regardless of whatever playbook we want to go to, I can tell you historically what consumers do when they get nervous, and they stop the aggressive buying in certain areas of the market, but they will gobble up on utilities, healthcare companies, and food.
It's classic playbook.
That is classic 101 rotation. And it's just the new age on top of that with the Apples, the Microsoft, and a little bit of the communications that has really given the market a boost here. But Mark, the trend in the market would suggest that we have a little bit more bullish momentum. It's just from an aggressive perspective, it's not that. What has actually occurred in the last week to 2 weeks in the market is, unlike other editions where the market was kind of to the top and you saw one sector show some weakness and come down and the other sector show strength coming back up in rotation, that's not what's really occurring. You have stabilization in certain sectors, and other sectors are joining the hit parade a little bit, showing you a little bit more bullish momentum out there from a sector perspective. But if there's one sector in aggressive, I would say comms. If there's one sector in cyclical, I would say energy, although gold would be its own class for me right now. But if there's one sector in defensive, I don't know. I'd have to debate.
I like plays in all three. Real estate, I put cyclical these days.
Well,
like,
you got to put real estate in the credit crunch conversation.
Yeah. It might as well be called cyclical sector in my world.
Yeah. Well,
no, but
is that where the biggest damage is going to come from the credit crunch? It's coming from commercial real estate.
Yeah, no, and some of those industrial properties that, listen, it's going to be an area out of favor. Eventually, it's going to be a buy. I think you get through. Once the recession is like here and you're a month or two in, I'm probably bottom fishing or looking for patterns, right? Like, you know, break out that playbook, right? Because markets in those areas, they tend to bottom long before the recession is over, right? And so, but until you get there, it just. But utilities, there's going to be some plays there. There's going to be some plays there. Healthcare, defense.
If I had to, I'd rank Staples one, just because I like the names in Staples a little bit more than healthcare. But I think we're debating.
Yeah, it's going to be really hard to see one of them running and the other not, right? You know, like
not in this environment.
In this environment.
They're running on the same theme right now.
Let's talk a little bit about commodities before we get into our conversation on the dollar, right? Gold broke out of 2K on the futures, right? G2K, right? I wouldn't be surprised, Matt, a little pullback, but I wouldn't be surprised. Just keep running too. Like right? Because you get stressed. Because you've been around gold long enough, right? You've seen the pullbacks when there's like, oh my gosh, it's not the end of the world where analysts take a week off. But I also there's a big anti-fiat. There is a big anti-dollar. The dollar chart itself sucks, right? Recession. I wouldn't be surprised you get like a 36-hour pullback and then you take a leg up, right? I just know I want exposure at this point. Is that where your head's at?
I think if you're waiting on that technical bounce, you're waiting on a pullback to 2K. I think that one's obvious. But outside of waiting on a short-term pullback, my long-term thesis on gold is not one that you want to trade in and out of. It's one that you want constant access to, that you want to be a part of that journey, not in the short term, but in the long term. Because when you look at some of the biggest mistakes traders make is constantly getting out in and out of things when they're long term.
Matt, let me raise my hand. Guilty of that in 10 years, right? That has been one of my. You identify a great thing, and then I'm going to try to overthink it instead of just like make it simple, stupid, right?
Especially with gold, right? Especially with gold. And so, yeah, the 2K breakout was really, really legit. It ran pretty quickly up into that 280 level. Now you're seeing a little bit of consolidation. The market's pulling back a little bit. Dollars faded. And so, yeah, if you're looking for a secondary pattern, a flag into 2K, that would be absolutely actionable with the bounce. But my long-term analysis on gold right now is fairly bullish. In fact, it'd be hard pressed for me to find a bigger bullish moment for me on gold than this moment is right now. And you're talking.
Man, I don't care about short-term fluctuations, which is huge for me because I care tremendously about making. I don't care. Like if my portfolio shows a loss in the short term, I believe in the thesis. I do. I believe you need to own
for the next 6 months. I want it for the next 6 years. Like there are things. Think about the conversation we're having last week, this week, and next week on the dollar. Every part of that conversation supports gold analysis. It supports diversifying from the currency the same way the international trading community is diversifying from a reserve perspective. And so if everybody and their dog can see the same writing on the wall, that the international community is diversifying from the dollar, which I feel is a much better word than trying to get rid of the dollar. They're not. You can't get rid of the dollar. You try to diversify your holdings from the dollar the same way people try to diversify, from a stock. For example, they want to add more than one stock, more than two stocks, more than three stocks. They don't want all their holdings lined up in the same type of asset class. And so if the entire world is trying to diversify from the dollar, I don't know why American consumers who are very familiar with this conversation doesn't simply do the exact same thing. Just diversify from the dollar. And the number one way to diversify from the dollar is to invest in gold.
Yeah, and I would, and we should have a debate. I would have a little Bitcoin in there too. I know I'm more on that thing, right? Same teams.
It's same teams. It's same teams in the anti-fiat.
Yes.
100%. 100%. Is Bitcoin, would it stave off an economic recession to the same way? I'm not sure. I'm not sure how that asset class.
I don't know about a recession. No, I'm just talking long term. A recession, gold. We don't have Bitcoin wasn't around in the last great.
I would definitely put it in diversification from fiat currency.
Yes, diversification from fiat long term.
That's why Bitcoin was created, was for that purpose. So yeah, I would definitely put it into the diversification argument. I just want to put it into the protection argument.
Little stat I'm going to share on my Sunday night prep class for my Cash Flow Vikings, Matt. If you are, don't fight the Fed. Don't fight the Feds. Central banks added the first 2 months of 2023, their most gold since 2010. You know who the biggest buyer last month was?
The U.S. Central Bank.
No, it was China.
It
was China.
I was going to say China or Russia.
Yeah.
That was my second two guesses.
Central banks been buying a lot of gold in recent years. A lot of gold. So listen,
it's almost like they want to back something with something.
It's almost like we're going to tie that into some currency analysis next week and speculating about a few things, right? But listen, there's a lot of reasons to own gold. There just really are. And I have a feeling like next week in part 3 of our currency conversation, we're going to talk about long-term ramifications, why you want to own all of that. One last thing, and let's get into part 2 of that. Just oil, right? Since last podcast, OPEC big announcement. Surprises the market. Saudis have your back. Oil stabilizes like it freaking gapped up on a earnings report and just hung out there. I'm hesitant. Like I said earlier in cyclicals as a whole, I'm hesitant directional because I'm just a buy the book. I believe a recession is going to come. And then you buy cyclicals like 2 months after the recession's here.
Got to
When
update
those
that playbook.
yeah, I know. Maybe I need to update that playbook, but I'm more, Saudis have your black. I like cash flow to the downside, naked puts, bull put spreads, whatever you want to want. Little hesitant on directional. Are those rational fears, or are they just standard
I think
national
they're
paranoia
rational.
feel?
I mean, when you're looking at it from a pure directional perspective, and if you're thinking about it from a pure technical perspective, you got to like the gap, and you got to like the reasons behind the gap in the futures market last week was
Everything. I would be like, let's take a shot here, right?
But the problem, especially for you, is you don't like elevated price thresholds. Your eyes don't do good there. And then when something immediately goes up there, you're gonna be a little hesitant, because that's like a big old green. Think about that big old green candle in between that.
That's why I still like comms. Comms isn't up there. It's still hanging out at the bottom.
Just especially on long-term charts.
Oh, especially on even up like 18%. It's still down there, right?
That's because it got slaughtered last year. And
You
but in terms of crude oil, the problem with the gap is it gapped right into resistance. And because that resistance level is so important over time, that 80 to 82 level, all of a sudden that 200-day moving average has converged right on top of the price action. And so, yeah, it's tough to look at it from a pure technical perspective and say, hey, let's giddy up and go here on crude oil, given the fact that you got the 200-day right on top of it. I do think giving it a little bit of time to see how that gets digested is probably wise, because when you're looking at a potential breakout, but the breakout doesn't have legitimate room to run, it's always going to be a very challenging environment from a pure technical perspective. And so for me, you got to like what occurred on crude oil. And if it wants to continue play defense, fantastic. But I do think energy, it would be the play on any potential breakout on crude oil.
Yeah, I know. It just has things backing it from a thematic standpoint. China reopening, China stimulus, OPEC having your back, that your average industrial stock does not have.
Right? This has the recession, though.
It does have that. It's not a perfect storm. It's not a perfect storm. All of that.
Perfect storm, we'd probably see the breakout already.
Yeah, no, look. All right, let's get into a currency conversation. Yeah. Matt, last week you took us from the dollar currency, walked us through different stages, the evolution. I still have my notes here. I have a new fresh notepad right now because I'm not lying, but that I learned many things. I find this serious. Like, I'm an academic. You're an academic. We like studying. We like history. We like all of that, right? You and I both the same like that. I would enjoy this type of conversation anytime. I find this a critical conversation for my understanding of how to implement real life decisions. I'm not talking about a swing trade. I'm not trying to talk about, let me sneak in a naked put, right?
It impacts all of us.
I'm talking about, all right, I need to understand this subject to make important decisions for my family's future. And I'm taking and approaching it. In fact, the amount of snarky conversations you hear in this will be at a zero, because this is a reverence conversation. This is an understanding conversation. And last week you took us through kind of the evolution of currency, right? From different forms of currency, backing by different commodities, some initial agreements. You took us through Bretton Woods, and you took us all the way up into the late 60s, early 70s. Why did we leave off at that time period, Matt? And where are we picking up?
Something happened in 1971 to kind of change the conversation. And when I look at the historical argument on currency, I kind of put it into three phases, right? You know how we all break up everything historically into certain time periods. You have your first time period, and this is just a quick review. You have your first time period that really goes from ancient Greece in 500 BC with Greek drachma coins that was used in international trade, and the first reserve currency was ancient Greece. Then it moved into ancient Rome, then it went into Byzantine, then it went into China, then it went into the Netherlands, and every country in Europe seemingly had about an 80 to 100-year time frame. But that first phase goes from when they just used coins in trade. silver coins, gold coins. They would also use other commodities, like silk was a commodity back then. And so silk would be in trade as well. Well, that goes up until China starts to do their first paper currency that's backed by copper. And that's kind of in that 9th century. And that goes all the way up from the 9th century all the way up until 1971. Not every currency that was ever created was backed by a coin. Lots of currencies were just backed by faith, and they ultimately ended up dying. In fact, every currency that has ever been created has ultimately came to a conclusion of death. That's the one thing with currencies. They kind of match life. You are born and you die. That's kind of how currencies last. And so a lot of times when they eventually fell, it's when either the faith and confidence in that country erodes, or two, they remove the commodity backing from it, and then it just becomes a debt conversation or an inflationary conversation. And typically, if you're not a reserve currency and you're going through hyperinflation, the only solution to that is to kill the problem with the inflation, and that's the currency. You kill the currency, all of a sudden everything's better. That lasts all the way up until 1971, including the dollar. Remember, the dollar was not just a faith-based currency at one point. It was a currency that was tied to gold, and it got tied to gold in the 1944 Bretton Woods Agreement. Now, Mark, that was not the first edition of the United States dollar. That was actually the 4th edition of the United States dollar. We are on the 4th edition of the dollar. The first currency in the U.S. was actually called the Continental Dollar. It died in the late 18th century. We had state-issued currencies before that. They all merged and were killed in the Continental Dollar. Then you had basically the first edition of the United States dollar lasted for about 20 years. The second edition lasted for about 20 years. And then you got to go all the way up until 1913 before you have the third official edition of the United States dollar that is tied to gold. And most US currencies were either tied to gold or silver of some capacity. But this one, when it became a reserve, was actually called the gold standard, as in 1944 during the Bretton Woods Agreement, when those 187 countries decided to agree to the US dollar becoming the reserve. They agreed if it was tied to gold, meaning you had a gold standard. So why that's important is when you're a commodity standard, you know, Mark, we talk about the United States Constitution all the time, right? It is the document that we basically created in the U.S., right? And it's very, very, very important to us within the United States is that United States Constitution. And one of the things that is absolutely beautiful in the United States Constitution is this concept of checks and balances, that we have 3 government agencies or organizations. You have the executive branch, you have the legislative branch, and then you have the judicial branch, that all of these create checks and balances on one another. Well, if that is not the case, the executive branch can run amok. And if that's not the case, the legislative branch can do whatever they want. And if that's not the case, we don't have a rule of law. And so you basically have these 3 branches of government created that is literally there to create a check on other areas of the government and a balance with other areas of the government. Well, the check on a currency is the commodity backing to that. Because when you have a commodity backing to a currency, you can only print to the level of the commodity you own, which is the check on you to aggressively going into debt, to aggressively issuing debt, to aggressively printing too much money. It is the check on that. Well, in 1944, when we created the Bretton Woods Agreement, that lasted up until the 1960s. And in the 1960s, you started seeing people like Henry Kissinger, Secretary of State Henry Kissinger, Richard Nixon, start to question the validity of having a gold standard. Now, Mark, the reason, and I'm just going to give it to you real, the reason we wanted to remove the gold standard from the equation is we were in a Cold War with Russia, with the Soviet Union, and we couldn't outspend them. We could only print to the level of commodity we owned against the dollar. And so all of a sudden in 1971, Richard Nixon, really Henry Kissinger, but Richard Nixon makes the announcement to remove the gold standard from the equation. Now, this was not in a singular moment in time. There was a lot of chatter going into it. And in response to that, the IMF, which is the International Monetary Fund, creates a basket of a currency known as the SDR in 1969. And so the reason we stopped in that 1970 timeframe was because in 1969, the IMF creates the SDR, and in 1971, and the SDR was created as a reserve. It is today. It's utilized as a reserve currency. In fact, if you go to the IMF's website and you ask them what the SDR is, it will literally tell you it is a reserve, that it is used in reserve by other countries, other governments, other central banks when they want to ship money throughout the world. And so in 1969, you have the SDR created. In 1971, you have the removal of the gold standard from the equation. Now, if all you ever did was remove the gold standard from the equation, I'm not sure we have a reserve currency called the United States dollar today. But in 1973, there was a very important agreement signed between Saudi Arabia and Henry Kissinger in 1973 called the Petrodollar Agreement. The Petrodollar Agreement basically stated that if Saudi Arabia, which is the #1 supplier of oil throughout the world, wants to sell oil, there's only one currency Saudi Arabia will take, and that's US dollars. And so when we removed the gold standard from the equation, we knew what the international trading community was going to say. We don't want the dollar. That's why the IMF creates the SDR to inject in that liquidity crisis, which, yes, there was that. They injected the SDR to replace the dollar in 1969. It didn't last because the SDR doesn't nearly have the liquidity of the United States bond market and the United States currency market. And then in 1973, Henry Kissinger signs the Petrodollar Agreement that basically now forces every country to once again buy dollars, because in 71 they said no. By 73, they now have to buy dollars again.
They literally have to in order to transact
their country oil. Their country shuts down
because everybody buys oil, right? And certainly in 71 still remains today. A lot of that oil is bought through Saudi Arabia, so you have to buy dollars. You have to have dollars in reserve in order to do those transactions. Is that what I'm hearing here?
And really, so the gold standard is replaced by the petrodollar standard. That's what occurs here. And so in that 4-year time frame, well, it's about a 6-year time frame because all of OPEC adopts it in 70.
I have a feeling we're going to revisit that whole petrodollar thing next week, aren't we?
It's coming down the
pipe. We're gonna. I want to fast forward, but I'm gonna shut up and let you continue.
Part of what's been happening in the last 20 years. But so the petrodollar standard is created, the black gold standard is created, right? Remember, you don't have to be a commodity standard from a physical commodity. You can be oil, you can be any, as long as you're a commodity, you can back anything to the commodity. That lasts up until about 1999. And by 1999, Mark, 90% of the entire oil market is financed directly in US dollars, Fast forward to 2009.
So wait, give me that previous stat again.
Okay, so SDR's created in 69. Gold standards ended in 71.
Yeah.
Petrodollar 73. All of OPEC expands in 75. In 1999, you have the injection of the euro at this point. And so you have the euro becoming an officially publicly traded currency, a reserve currency held by the SDR, a reserve currency held by over 100 other countries, including most of all of Africa, which is very important because the euro is a diversified currency. It doesn't have one currency like the dollar has. It's a diverse currency, and that's what the world wants. They want to move to a diverse currency system. And so the euro is created as a competitor to the reserve conversation of the dollar. and this is kind of the height of the dollar supremacy.
Well, yeah, I'm thinking just from my own understanding of history, like China's economic, resurgence or their surge, it wasn't happening in the 70s and the early and the mid 80s, right? There's, this has been a recent decade phenomenon. They were starting to lay the groundwork, but they certainly weren't.
But they don't lay that very important groundwork in the free trade agreement between the U.S. and China in the early 1970s. There's no 1990s explosion of growth conversation.
The euro was what you had a bunch of European currencies, in the 70s and the 80s.
At 17.
And so we didn't have a real, like, nobody was positioned to even come close to be a competitor.
And
the
Japanese yen was a really strong competitor to replace the United States dollar in the early to mid 1980s. Remember, the 1970s was not a good year, not a good decade in America.
Or anything.
It was a really, really difficult decade. Japan was a booming economy. It was coming out of the emerging economy perspective. It was the third most utilized currency in the world up until at that point. It's still like the fourth most utilized currency as of right now. But there was a lot of chatter in the 1980s of Japan ultimately becoming that reserve competitor to America. The problem is they got explosion of debt, and then basically went through 30 consecutive years of just economic stagnation from a currency perspective, and they couldn't grow. And yes, some of the same policies that led to that mistake in Japan are some of the same missteps we've taken over the last 20 years. But there was a competitor, Mark. It was Japan. I don't know how close of a competitor it was, but there was that one competitor. But there was no competition in the 90s.
Because Japan's markets imploded, and so
late 80s was nasty. Late 80s, all of 90s were
all right. So we got we'll just call it a multi. And a side note, Henry Kissinger. Wow, what a productive human being.
Listen, I know Kissinger has some haters on Kissinger.
Yeah, but the guy got stuff done.
Name me a secretary of state that did more than Henry Kissinger did.
Oh my goodness gracious! Got the things on that guy's resume. Impressive.
All of Asian markets. Petrodollar agreement, which dominated for 40 consecutive years. He had a 5-year stretch that is historical. It rivals Nicolas Cage's IMBD from the late 1990s of greatness.
I'm going to actually not be lazy and clean out my garage tonight.
Self-productive.
Just because Kissinger was like, my goodness.
He got a lot done. There's no doubt.
All right. 1999, the euro, comes on the scene. We've had a multi-decade of dominance, removal of gold standard, that petrodollar. Mark that, because I think that's going to be a very important part of our conversation next week. And so as we hit the year 2000, you've painted a very clear picture of the last 3 decades, right? Makes perfect sense to me. How do things start to evolve in that part at the start of 2000?
There's a couple things that happened in the 1999 to 2003 timeframe. Number one is you basically had the emergence of the euro, which again is a direct competitor to the dollar, and not just in the Eurozone, specifically Asia, which just came through a horrible Asian currency crisis from 97 to 99. So there's a lot of Asian countries that are thirsting a little bit of diversity in currency. Euro provides that. And a tremendous amount of African countries, which you got to go all the way back 200 years to understand the imperialism of Africa and the Eurozone. And it's specifically from a currency perspective in the year 2000. But a lot of African countries also adopt the euro as an official reserve currency as well. That starts stinking the dollar. But you also had a very significant, because again, you don't have a gold standard, which means you only have 2 things back in the dollar as of right now, up in 1999, 2000. You had the petrodollar, which forces every country around the world to diverge their currency by buying dollars to spend on any oil product from any country that deals in any oil market. So that's number one. And the second thing is just the ultimate faith and confidence, which is really the U.S. military. We can talk about faith and confidence all we want, but it's really the U.S. military that adds a little bit of that faith and confidence in the backing of the dollar. But in 1999, 2000, 2001, 2002, for the first time in about 25 years, Mark, you had the emergence of countries in the Middle East that were willing to do business without the United States. And specifically, Saddam Hussein goes to Europe and basically signs an agreement to sell oil to Russia and China, not in US dollars, but in euros. And so all of a sudden, what does Russia and China want to do? They want to buy more euros, less dollars, right? Because they want to buy oil from Iraq. Well, that was the first time in about 25 years that a country in the Middle East said no to us and yes to somebody out of Europe or somebody around the world when there was a competitor. Because again, before this, there's no competitor. But there was also, like, we were at war for a good 8 years going into this with Iraq. And, I'm not going to retell that story here today. But there was obviously some reasons why Saddam wanted to go and use the euro instead of the dollar. Now, our response to that was quite historic. Obviously, we went to war and we wrapped them up with the 9/11 type conversation when it was proven historically that Iraq didn't really have anything to do with 9/11. But we all know what we really were doing over there. And what we were really doing over there is securing our oil rights in the region.
Yeah, no, I mean, what's funny is if you would have said that at the time, 22 years ago, 20 years ago, it's your wild conspiracy theorist, right? But
it's understandable. I mean,
emotions were high.
It's hard to know the truth of these international trade agreements in the moment when we're dealing just 6 months before this.
So what you're telling me is Malaysia should watch out? Is that what you're telling me?
No, I am not saying that.
I promise no snarky comment. Okay.
Listen, it's one thing when one country says it 20 years ago. It's a vastly different thing when Canada says it. It's a vastly different thing when Japan says it. Mark, Japan and China are historical enemies. And yet Japan and China a few years ago signed a trade agreement. And Japan is our number one ally in the region. We have nukes in Japan for Japan. Like, not Japan. They don't own nukes. We do. We protect them. We have our aircraft carriers there just facing the South Chinese Sea, facing North Korea. And there's Japan, one of our closest allies in the entire world, signing a trade agreement with their hated rival in China to use non-US dollar transactions in international trade. So it's one thing when Saddam says, hey, we're going to sell oil to Russia and China in euros and not dollars. Yeah, our response is going to be quick, it's going to be swift, and it's going to be powerful, and we're going to bomb you. That's what we're going to do. But all of a sudden, what are you going to do? Bomb Japan? And why? And you might ask yourself, why would Japan do this? Because we created the efficient, cheap labor conditions of the 1970s in China. We created this beast because we wanted to outsource all of our expensive labor to cheaper labor conditions in the 1980s. And then we wanted to import those cheap Chinese labor through free trade agreements. That's what we created. And so we create this sleeping giant called China, this efficient, cheap labor condition called China. And all of a sudden, our most important allies called Japan are signing trade agreements with China to use non-US dollar transactions in international trade. And you got to ask yourself, why? Here's the why. Because they buy more cheap Chinese goods from China than they buy from us. That's the why. And so, yeah, in 20 years ago, you can go bomb Iraq. You can't bomb Canada. You can't bomb Japan. Mark, China's signing these trade agreements with everybody.
And is it accelerating? And this feels like a good stopping point for this point in the history. And let me just preview next week. I mean, you're the expert. You tell me if I'm missing anything. We're going to go through basically this expansion, right? It starts with Iraq as the first one in a while. But we've had an expansion, an acceleration in recent years, hell, an acceleration in recent weeks, it feels like. And then, kind of like looking at where this is heading and the ramifications thereof. Does that seem like our conversation next week?
The time period from 99 to 2007 is very, very important, right? Because you have the first weakness of the petrodollar, which you can't really call the petrodollar any longer, because now like Saudi Arabia themselves are literally today selling oil to China in Chinese yuan. Right now, Saudi Arabia is accepting Chinese yuan to sell oil to Russia. Okay. And so, yes, 1999 is really kind of that important year. The things that happened between 2002 to 2007 are very, very important, though, because I do not believe that we would have had as big of a move away from the dollar internationally if we didn't deregulate the US banks to the point of no regulations from 1997 till 2007, because I don't think the rest of the world would have fought against the US banking system that much if it wasn't for us creating the subprime meltdown in the first place. It was our greed in America by reducing banking regulations in the 1990s that led to the 2007 collapse. And it was those decisions that we made that, because 14 of the largest 15 banks are US banks, and they're spread throughout the entire world. And so you can't tell the story of the emergence of China without talking about some of the things that we have done to create the efficiency of China. But that does bring us to that 2009 year. And I do believe in 2009, post 10 years of Middle Eastern countries trying to move away from the dollar, post 10 years of the introduction of the euro, post 10 years of all of that, I do believe in 2009, China made a strategic decision to build their reserve currency. In 2009, Mark, not one Chinese yuan was settled in international trade. China would sell their goods in any other country, any other currency, never Chinese yuan. No country held Chinese yuan in reserve, none. 10 years later, the IMF holds the Chinese yuan as the third or the fourth, kind of tied right there with the Japanese yen, for the largest percentage of the holding of the SDR is the Chinese yuan. 12 years ago, 0% of Chinese trade was settled in renminbi. Now a majority of it is. And so, yes, 2009, China made a strategic decision to become a reserve international currency. And everything they have done in the last 13 years since that moment has been towards that goal of not replacing the dollar, because that is a very, very that's the long game. That's the long game. And by the way, I'm not even sold on the argument that China wants to be the reserve of the world, Mark. I'm not sold on that argument, because being the reserve, yeah, there's benefits, but there's also
that's not even their tactical plan.
I don't think it is. I do not think it is, because, Mark, if everybody has to own Chinese yuan in reserve, that's going to create a massive amount of demand for Chinese yuan. And China's country is an exporting country. They're not an importing country. That would harm their exports. China has done anything they can to keep their currency low. They want to feed their exporting the steroids of their exporting. They don't want to be the only reserve. When you listen to what these individuals say in their speeches, when you listen to their trade agreements and what they say in their trade agreements, when you remove the geopolitical goggles from your own eyes and you look at that with just a fresh mind, with a fresh slate, it doesn't lead to the conclusion that the Chinese want to kill the United States dollar. It leads you to the conclusion that every one of these individuals, including Macron in France, Putin in Russia, and President Xi Jinping in China, what they talk about is the unfair advantage. And by the way, I bleed red, white, and blue. I want the dollar to keep its reserve status. Let's do everything we can. We don't want to see all that money come home where inflation sets in. We'll talk about that next week. But what they talk about is creating a fair and balanced playing field from a reserve perspective. They speak about removing the risk of a single currency system and creating more of a basket, because Mark, 2008 to 2009, the subprime meltdown, once again, our greed created that. Our reduction of banking regulations and the constant thirst for yield created that. Our constant desire to create more growth and more growth and more growth, that created that. Nobody can own the banking crisis of 08 like the United States can own the banking crisis of 08. But that banking crisis was felt by the entire world for an entire decade. And the reason is because every bank is tied to the US banking situation around the entire world, because every bank uses US dollars. And so from 2009 on, it was not just the radical dictators of President Xi Jinping out of China and Putin out of Russia that was talking about moving away from the dollar. It was the likes of Canada. It was the likes of Japan. It was the likes of the IMF, which is the International Monetary Fund, basically ran by the United States, made an agreement with China to inject the Chinese yuan within the basket of the currencies. And that was 8 years ago, Mark. And so this date of 2009 and the impact that the subprime market had on the international markets, basically all proclaiming in unison together, it's time. It's time to diversify the international reserve system from a single currency to more of a basket of currencies. So if one country ever goes through what the United States did again, the entire world doesn't have to feel it. They said that in 09. It was an isolationist movement that initially happened in 09, similar to what's been occurring after the pandemic, Mark. The pandemic will feed into this. And so it's not shocking to me that China's making these agreements with Malaysia. It's not shocking to me that Macron on a Sunday Easter is talking about removing the United States dollar. But again, I also want people to understand that diversifying from a currency is a vastly different conversation than the removal of said currency. I've long held the belief, I said it last week, I'll say it this week, and I feel this trade agreement was signed 8 years ago is what I feel this trade agreement was signed and backed by the United States, that no longer will the dollar be king, queen, and country from a reserve perspective. Over time, and I don't think this is a new trade agreement, Mark. I think these are old trade agreements that are just processing throughout the world, is that we will remove the dollar from a single reserve and we will move into a basket of currency. And there's only one basket out there that fits what everybody's looking for, and that's the SDR. And the SDR stands for Special Drawing Rights. It was created in 69. It was injected as a reserve in 69 through 71. It was re-injected as a reserve from 78 to 82. It was re-injected as a reserve following the dot-com. And it was then re-injected as another reserve 13 years ago to the tune of over $500 billion worth. We're talking about a large market now. It wasn't a large market 7 years ago, Mark. The SDR is something to keep your eye on. I'll talk about the SDR at length next week, because that's part of this, the future of the currency system. So next week, I just wanted to talk about 09 in China there for a second, because that's a very important.
Yeah, it's fascinating stuff. It's fascinating stuff.
When we look at next week's podcast, we're going to be dialed in from 09. I'm going to walk through all the trade agreements. We're going to get into the pandemic. We're going to talk about the current state of affairs from an international perspective, and we're going to talk about what is next for the dollar, what is next for the reserve currency, and how does gold, how does Bitcoin fit into those theses as well. And I've long held the belief that while we're having these conversations, yeah, other people might get a little freaked out over currency conversations. I kind of approach it like Warren Buffett talked about. Currency is the new knowledge is the new currency. It's not dollars, it's not euros, it's not yen, it's not Bitcoin. Knowledge is the new currency. And with knowledge, you can overcome any of these emotional conversations. So I hope today helped out with a little bit of that knowledge and understanding what has happened and transpired from a historical perspective. Because if you can't talk to me about the historical argument on the dollar and what we have went through and the reason we're at that point to where we're at today, how in the world can you talk about intelligently over what to do about that in the future? And so I hope the last couple of weeks has brought people to the understanding of what historically transpired. And then next week, we're going to get into the last 10 years and the future expectation.
Yeah, no, it's good stuff. It's just good stuff. I know I appreciate it as a consumer, even though I'm here as a participant. I appreciate it. Very much looking forward to next week's conversation. And next week, we'll also give a little earnings preview as earnings season is going to kick off. So we'll talk about earnings season, and then we're going to do part 3.
We might have a priced in conversation, Mark.
Dude, that's going to take a whole debate. That's going to take
earnings priced in. You're
nothing.
not going to get. I'm not done with that conversation.
Oh, dude, nothing's priced in, bro. It is just algos upon algo. I
will tell you
endlessly.
Next week we're going into earnings season. We'll have a couple earnings. We'll do a full earnings preview. Do the phase 3 of the currency conversation. So a big podcast next week. But earnings does kick off this week. Very important earnings season, as they all are. I want to hear from the banks, and we get them later on this week. So keep an eye on that. Also, economically this week, we start to pick up the economic data. Labor market came in on Friday, nothing to see. But this week, you get a little bit more economic data. CPI report coming in on Wednesday, FOMC minutes on Wednesday, PPI report on Thursday, core retail sales on Friday, the University of Michigan Consumer Sentiment Report on Friday. And yes, it is on Friday where you have the banks reporting earnings as well. So a lot of fireworks to be had this week, no doubt about that.
Yeah, absolutely. Absolutely. And listen, Matt, close off just talking a little bit about option success. We're going to have a big event in a couple of weeks. Talk about option success training. It's something that we've included in our pro package at Tackle Trading. Such a great addition. It's a great class.
It's a great class. It's a live class. We do a lot of webinars at Tackle Trading. We have a lot of self-paced on-demand courses at Tackle Trading. We don't have a lot of live courses where one of us coaches sit down, teaches a concept from A to Z, systematic approach. And that's what the options success class is all about. Coach Gino and myself, we teach it about every 3 weeks to our pro member community. And we made the decision to just include it with anybody that is a pro member can attend that class as much as they want. They can attend. The only thing is, if you register, I'm expecting you to be there for 2 days, not just to show up for 5 minutes and say hi. This is a registered type class where people are going through structured education, learning technical analysis and the basics of options. If you're a new trader, if you're coming back to the market after an extended hiatus, this is a perfect class for you. If you're an intermediate, I promise you will still learn certain things and review other things, but it's an awesome class for all traders alike. It's available if you are a pro member. The next class, I believe, is on, I want to say April 24th and 25th. It's 2 weeks from now. And so if you're a pro member, let us know if you want to attend that class. I'm sure I'll have more information in Discord. And if you are not a pro member, this is a perfect time to become a pro member of Tackle Trading. Not only do we have the best application products, such as the scouting reports, the Tackle Trading newsletter, we have over 15 different webinars on a weekly basis for our pro member community that you can come in, out, check in, hang out, do whatever you do. But we also have just the absolute cream of the crop, best beginner to intermediate level course that is included with the pro membership as well. No education company provides the depth and value like Tackle Trading does. And so if you are looking for education, amazing education, sign up for a free course for Tackle Trading by signing up for a free trial at tackletrading.com, and then get registered for the next option success class, which is on the 24th and 25th.
The good stuff, good stuff. Listen, we'll be back with 523 next week. Catch us on the halftime report throughout the week on YouTube. Have a good week, everyone.